Hi friends, welcome to my channel InfoCraze. In today's video, we are diving into one of the most fundamental aspects of financial statements, the balance sheet. Whether you are a student, a finance professional, or just someone who is curious about how businesses keep track of their financial health, this video is for you. We will start with the basics of a balance sheet and then guide you to get an understanding on how a balance sheet is prepared. By the end of this video, you will have a solid understanding of the key components of a balance sheet and how they all fit together to give a snapshot of a company's financial position. So let's get started with the basic question. What is a balance sheet? Balance sheet is a financial statement that reports all the assets, liabilities and shareholders' equity of a company as on a particular date. In simple terms, a balance sheet is a financial statement that provides a snapshot of all the things that a business owns and the things that a business owes. The assets of a company, that is everything a business owns, are funded by a combination of liabilities to external parties and owners' equity, that is the money invested by owners. As all the assets of a company are funded by the liabilities and shareholders' equity, total of these two sides are always equal. Thus, balance sheet follows the accounting equation assets equal to liabilities plus equity. A balance sheet is divided into three main sections: assets, liabilities and equity. Let's break this down one by one. Assets are divided into two broad categories: current assets and non-current assets. Current assets are the assets which are expected to be converted into cash or used up within a year. Non-current assets are long-term investments that are not expected to be converted into cash within a year. Next, let's talk about liabilities. Like assets, liabilities are also split into current liabilities and non-current liabilities. Current liabilities are obligations that need to be settled within a year. Non-current liabilities are debts or obligations that are due after 1 year. Finally, we have the equity. Equity represents the shareholders' funds. In some cases, it may also include the share application money pending for allotment. Now, let's see what all are included in these 6 broad categories. Current assets include cash or bank, accounts receivable, inventory, and prepaid expenses. Non-current assets include property, plant and equipment, intangible assets like patents, and long-term investments. Examples of current liabilities are accounts payable, short-term loans, and accrued expenses. Non-current liabilities include long-term loans, bonds payable, and deferred tax liabilities. Shareholders' funds include share capital, retained earnings, and additional paid-in capital. Retained earnings are profits that have been reinvested into the business rather than paid out as dividends. Share application money pending allotment refers to the funds that investors have paid to a company while applying for shares, but the same have not yet been allotted to them. This situation typically occurs during a company's initial public offering or a new share issue. Now, let's check how we can prepare a balance sheet from some given data. Let's consider some sample business transactions and capture the data related to the accounts affected. Let's assume John starts a company named John Enterprises by investing $50,000 in check on 1st March 2024. As per the double entry accounting system, 2 accounts of the business will be affected here. Due to the receipt of the check of $50,000 by the company, the bank balance, which is an asset, will increase by $50,000. Since amount is invested as capital investment from the owner, the owner's equity will also increase by $50,000. Thus, the closing balances on 1st March 2024 will be as per this chart, when bank balance will be $50,000 and owner's equity will be $50,000. Next, on 5th March 2024, assume the transaction inventory worth $10,000 purchased on credit. As inventory is purchased, it will increase by $10,000. As the purchase is done on credit, the supplier's account will be credited, which means the accounts payable will increase by $10,000. The chart given here show the opening balances, changes due to the current transaction, and the closing balances. Now in this chart, we will see that inventory have been added with a balance of $10,000 and accounts payable also got added by $10,000. Hope this is clear. Now let's get on to the next transaction, which happened on 10th of March 2024. Assume the transaction, the business sells goods worth $8,000 on credit. Thus, it will increase sales revenue by $8,000. As the goods are sold on credit, customer's account will be debited. Thus, accounts receivable will increase by $8,000. As the cost of goods sold is $5,000, inventory will reduce by $5,000 and COGS will increase by $5,000. The difference between sales revenue $8,000 and COGS $5,000 gives the gross profit of $3,000, which ultimately increases the retained earnings. After considering these changes, the account balances will change on 10th March 2024, which is given in this chart, where we can see that accounts receivable got added to the chart by $8,000. Retained earnings also got added to the chart with $3,000. And since there was a sale, the inventory got reduced by $5,000. Next, on 15th March 2024, consider that the business pays $1,000 for utility bills by check. As there is a check payment, bank balance will reduce by $1,000 and the utilities expense balance will increase by $1,000. As we know, any expense incurred will reduce the net profit, ultimately reducing the retained earnings. Thus, after considering these changes, the account balances will change on 15th March 2024, which is given in this chart. So you see the changes in the column given as add or minus, and we also get all the closing balances. Hope you have understood till now. Next, on 20th March 2024, the business collects $6,000 by check against the credit sales made on 10th March 2024. As there is a check deposited into the bank balance will increase by $6,000. As the payment is made by the customer, accounts receivable balance will reduce by $6,000. So, after considering these changes, the account balances will change on 20th March 2024, which is given in this chart. So, we have shown the increase in the bank balance and we have also shown the decrease in the accounts receivable balance. Hope this is clear. Further, as on 25th March 2024, the business pays $8,000 by check to the supplier for inventory purchased on 5th March 2024. As the payment is made from bank, the balance will reduce by $8,000. As the payment is made to the supplier, the accounts payable balance will decrease by $8,000. After considering these changes, the account balances will change on 25th March 2024, which is given in this chart, where we can see that bank balance has reduced by $8,000 and accounts payable account have reduced by $8,000. Now, on 30th March 2024, the company John Enterprises takes a long-term loan of $20,000 from a lender for business expansion. As the money is received in bank, the bank balance will increase by $20,000. Simultaneously, long-term loan balance will increase by $20,000. After considering these changes, the account balances will change on 30th March 2024, which is given in this chart. You can see that long-term loan which got added by $20,000 and the bank balance also gets increased by $20,000. Now, assume that on 31st March 2024, the company buys equipment worth of $15,000 by check payment. So, equipment account balance increases by $15,000. As the payment is made by check, bank balance will decrease by $15,000. After considering these changes, the closing account balances that we get have been shown in this chart, whereby you can see that the bank balance has decreased by $15,000 and there is an additional row for equipment which got added by $15,000 on 31st March 2024. After we have recorded all these transactions, now we get the closing balances of all the accounts on 31st March 2024. Thus, in the books of John Enterprises, the equity and liabilities section of balance sheet will have the following items as on 31st March 2024. The total equity and liabilities is $74,000. All these balances are picked up from the closing balances that we worked out earlier. So far as the assets are concerned, we have the following items in this section, total being $74,000. Thus, all the assets on one side and liabilities and equity on the other side are same. This is achieved by the double entry accounting system. Hope you have understood the fundamentals by which every transaction got captured in the balance sheet. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Please subscribe to my channel for many more interesting videos in the field of finance, accounts and costing. If you have any question, please leave your query in the comment section. Thanks for watching.